Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guest today is Robert Keebler, CPA, PFS, MST, AEP Distinguished. Bob is a partner with Keebler Associates and the current chairman of the AICPA Advanced Estate Planning Conference. In 2007, he was inducted into the Estate Planning Hall of Fame of National Association of Estate Planners and Counsels. So welcome to the podcast, Bob.
Good day, Bob. It's great to be here.
Great to have you here. Before we get started, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview?
Sure. We have a boutique CPA firm, and we're in Green Bay, Wisconsin, mostly serving all of our expertise. Kind of the genesis of it was the early 1990s when people were retiring from the paper mills with $2-3 million in their pension plans. And they were retiring before 59 and a half. They had NUA stock. And so we became very good at NUA because we had to. That was the clients that were asking for our help. And then the Roth came along, and I wrote the AICPA's book on the Roth IRA, long time, over 20 years ago. And since then, we've done a lot of work in the Roth area and have tried really hard to figure out the break points of when people should convert and when they shouldn't.
Right. So speaking of Roth, that's the topic of our conversation today. You've done numerous webinars over the past few years about Roth conversions, having, among other things, the potential to unlock hidden value, and that you think 2022 is especially effective year to consider conversion, as many marginal tax rate increases seem to be clearly on the horizon. So I'll let you dive into where you think is the most important place to start this conversation.
Sure. The beauty of 2022 is that rates may go up. And so that would say you convert before rates go up. We could also some point in time have to deal with the Build Back Better bill. And remember, they had all those punishing provisions of Build Back Better if you had more than $10 million in your IRA. Now, not many people have more than $10 million, I'll admit that. But for those that do, Roth conversions are going to be very appropriate, very efficacious, because I can pay tax at 37% today or 39.6 plus an 8% surtax later. It's just amazing what's going to happen if there's two elements of Build Back Better that we have to glue together to understand why Roth is important for the very wealthy. A, an 8% surcharge, and B, also just the whole idea of everything over 10 million having a forced RMD. If those two things come together, you want to get ahead of that and do your conversions before that becomes law. And now Congress right now pushed that way out to happening at the end of the decade. So there's no immediate urgency on that, even if it passes in its current form. But the thing that financial planners need to pay very close attention to is, just yesterday, Senator Manchin said Build Back Better was dead. At the same time, Senator Schumer and President Biden want to pass it. So they're going to have to come up with a compromise. And what we have to watch for is that the compromise is not some bride of Frankenstein, just all kinds of provisions glued together with no input from people with PhDs in economics, but all done by bartering, like you'd barter for something if you went to an art fair. Right. And so that's the scary part. And that's why we all need to pay very close attention to Build Back Better, its effective dates, just so that if we have to move quickly, we can.
Right.
So that's something that's out there.
So we have a sort of a cheat sheet of things to go through. I'm going to leave the driving to you and ask questions along the way, if that's okay.
Well, that's fine. So we have to focus on Build Back Better. Then we have to understand the new rules under Secure. The 10-year payout under Secure actually makes a Roth conversion better. Because you see, if I start at age 60 doing Roth conversions and I die when I'm 85, I've done small Roth conversions managing my brackets over 25 years. But if I die and my kids have to take it all out within 5 years or 10 years, that is a disaster. More bracket compression. And so we'll go through the core concepts. We'll talk about how Secure has changed things. Very important for everybody to realize no more recharacterizations. So the game of converting and recharacterizing is totally over. And that's going to be the problem we're running into here, which if you have this, you can reach out to me and I can tell you if we've come up with any solutions. But Bob, people are making mistakes when they convert to a Roth by themselves on the computer. So you go in to your account and you're hoping to convert $3,000, but you convert $30,000 or you convert $300,000. And with no recharacterization, there's no mechanism to fix this. Congress is going to have to address kind of like a certified recharacterization where a CPA or tax lawyer signs off that, they've talked to you, you made an honest mistake when you did the conversion yourself. I've not seen mistakes made by the financial advisory firms. When they enter the information, it's usually when the client does it themselves.
Right.
They're not familiar with the program. And it's very unfair to think that I'm going to get something right the first time when the punishment is so severe. Because I have a gentleman who converted over $1 million. He was hoping to convert 10,000 and he ends up converting over $1 million.
Oh,
and, we just can't find a way to help him. Now, keep in mind, if you're a financial planner and you're helping with Roth conversions, you want to make sure that the client is getting all their estimates right so they don't end up in a penalty situation. You also want to watch out for SALT, because if SALT comes back, you want to pay your state income taxes at the right time so you can get a benefit for them, if that makes sense.
Right.
Now, if we look at the big picture time frame, the 1998 Taxpayer Relief Act is where all this started. The Roth IRA was named after a senator from Delaware, Senator Roth, and really very little changed until 2010 when they opened up conversions to everyone, because from 98 through 2010, you could only convert if your income was below $100,000. That is no longer the rule. Now, Build Back Better may have some restrictions on this. We're going to have to watch that. But right now, we have a wide open Roth conversion, meaning somebody that makes $1 million a year with $5 million or $10 million in their IRA can still do a conversion.
Mm-hmm.
And then along the way, the next biggest change was in 2020 when we went to a 10-year postmortem payout under the Secure bill. So that's the big thing. And then Build Back Better would have done many things, including distributions if you're over 10 million, forced distributions, stopping the backdoor Roth IRA, which is a wonderful planning technique, and also not allowing you to convert it all to a Roth if you already had too much money in your Roth IRA.
Right.
So the Secure Act, what the Secure Act did, all it said is instead of using life expectancy distributions, we had to use distributions within a 10-year period of time. So we had to use distributions within a 10-year period of time. And when you compare the two, there's absolutely no doubt that you'd much sooner have a 40-year payout than a 10-year payout. That's relatively easy.
Right.
Now, there are 5 important exceptions that we have to focus on. Okay, so let's talk about those just a little bit. The first exception is surviving spouse. I leave my IRA to my wife. She is not subject to the 10-year rule. She can either roll it over or she can leave it as an inherited IRA. The old spousal rollover trap where the wife does a rollover before 59.5 is still there, and it's still just as ugly as it's always been. Meaning we have to be very careful not to let a lady under 59.5 do a complete rollover, because simply put, she will not be able to get to that money. Now, there's also an exception for your own children under the age of majority. So say you had a friend, he was in his 40s, he died, and he had a child who was 12. That 12-year-old would be able to use their life expectancy until they reached age 18 or 21, IRS hasn't clarified this yet. And then they would have to go to the 10-year rule, but they would get a break for a while. The statute also protects disabled and chronically ill individuals, and it protects an individual not more than 10 years younger than the employee. Bob, for example, if you had a brother that was 3 years younger than you and you left him your IRA, he would be able to use his life expectancy rather than the 10-year rule. So that's kind of a big thing. Now, on the secure bill going forward, there are a number of choices that we have to work with. You have the exceptions for your spouse, a minor child, a person less than 10 years younger, or somebody disabled and chronically ill. When you get, this is a very important point for the financial planners, when you get to someone disabled or chronically ill, it's absolutely critical that you evaluate whether you should do a Roth conversion before the parent dies, leaving the money to the disabled or chronically ill child. Now, why is that? Most of the time, we're going to do it in trust. But trusts have really high tax rates. Just around $13,000 were in the highest rate. But if grandma and grandpa do a Roth conversion before they die, maybe we can pay tax at 12 or 22 or 24 rather than having to pay tax at that very high tax rate later. So that's important. So we do have to be very careful. Now, I think the important thing is that the financial advisors be able to spot these issues and raise these questions, okay? And that's something that, you know, we work very hard on, and trying to teach financial advisors really where are the important issues, what to observe, because the problem is many of our lawyer friends are working really hard on getting Rev Trust done and all of the estate planning things done. And sometimes the income tax planning for these IRAs doesn't get the attention it deserves. And we can bring, these ideas are not, knowing what to do is sometimes harder than knowing how to do it. Meaning spotting what to do, that triage skill is where the financial advisors can really add value. Now, if you have,
I was just to interrupt for a second, Bob. It sounds like this is an area where you need a checklist or a flow chart of some sort, just to make sure that you're covering all your bases and right with respect to beneficiaries.
well, exactly. And the one thing that, just as a sidebar, when we teach these classes, we really encourage the lawyers and financial advisors to collaborate on these beneficiary forms, because we want that beneficiary form woven into the fabric of the rest of the estate plan. We do not want the financial advisor drafting it one way pursuant to the client's instructions and having the lawyer put together the estate plan a different way pursuant to the client's instructions. Both are doing exactly what the client wanted, but it doesn't work together.
Right.
And it's better, I think the financial advisors reduce their risk of any type of malpractice by just letting the lawyer physically draft the beneficiary forms, submit it to you as the financial advisor, and you get it executed through the company or perfected through the company.
Mm-hmm.
The reason Roths will work better for disabled and chronically ill people is because we've already paid the taxes, Bob.
Right.
So right up front, you paid those taxes, and you never have to worry about that again. And because otherwise, if I have a disabled child and the money goes to the trust, we're going to lose 37% of it to tax. That's a given. But if we do a Roth first, maybe we only lose 22 or 24. So that's something to really think about. Now, the other thing that the financial advisors really need to know is something we call the Roth reprieve. If I die today, my children have a choice of taking all the money out year one. They could take it out equally over a 10 or 20 year period of time, or 10-year period of time, or they could take it all out at the end of year 10. And at the end of the day, what we want to do, the very important thing that we want to do is we want to take the money out probably at the end of year 10, especially with a Roth, because Bob, all the growth will be tax-free. So don't let anyone tell you you have to take out evenly over 10 years. That's just not true, okay? You can wait to the end. So if you were representing someone and they were left $1 million in securities and $1 million in a Roth, and they needed 20 years of living expenses, $100,000 a year, you would say, let's spend down the securities first. We'll take the money out of the Roths in year, basically 11 through 20. Or let me say that differently. We'll take all the money out of the Roth at the end of year 10, but we'll let it grow for those first 10 years. So that's really important to lay that out from a spend down perspective. The math supports that.
Yeah. So would that be the case even if a beneficiary was in an especially low tax year where it might be advantageous to take a partial or full distribution, or is it?
Well, with a regular IRA, that's exactly what you do. You would have the client's CPA spreadsheet all this and figure out when to take the money. But with a Roth IRA, there's no tax.
Right.
So you would try to wait to the last possible moment to take that money out, if that works cash flow wise.
Right. And then in terms of the assets within the Roth, I mean, I've been told that an in-kind distribution can be effective for some types of assets.
Exactly. You can do that if you'd like to. There's especially something that you don't want to get rid of that you think is a good long-term hold.
Right.
So the best practice is often to use Roth conversions to spread taxable income out over many years and enjoy those lower brackets on the conversion side. So if somebody retires, they would go down that path of doing small, very methodical conversions. That would be something that would be really important to do. And then you have to look at what other reasons might they have to convert. And this becomes very important. And I can go through some of those. Like, for example, if somebody had a loss carry forward, they could use that loss carry forward to shelter 80% of a Roth conversion. If they had a charitable carry forward, they could use that to shelter part of a Roth conversion. So we should always be on the lookout for carry forwards and for what I'll call a high basis ratio. So Bob, husband and wife come to see you. Husband has $50,000 in his IRA with a basis of $45,000, 90% basis. He is the perfect candidate for a Roth conversion because his basis ratio is so high. His wife, on the other hand, is already retired. She has $750,000 in her IRA with a $45,000 basis. That alone would not be a good reason for her to convert. You would convert the husband's IRA way before you convert his wife's IRA because 90% of it will be tax-free. When you have basis, you can move that basis basically into Roth without paying a penny of tax. It's just the growth, that $5,000 of growth in that $50,000 example that would be subject to income tax. So very important for financial advisors to look at husband's basis ratio and wife's basis ratio that in the IRA. Now, what happens is when you move money from the pension plan into the IRA, you expand the denominator of that ratio. You lose the ability to do a nice, clean, high basis conversion. So we always try to do those in a year or two before somebody retires. Now, when somebody retires, though, if you handle it right, you can move after-tax dollars into a Roth IRA. Some pension plans, especially for people that are, in their 60s and 70s, when they were younger, they were able to put after-tax dollars in their plans. And those can be put into a Roth IRA and isolated. That is very, very important because it's just a good, solid planning technique. So we want to be able to spot those situations. We also want to look at, will your client need money after they turn age 72? Now, let me take everybody back to junior year of high school where we learned about slopes and all of that math. A slope starting at age 60, unmitigated, going to age 90, would have a certain trajectory. But at age 72, it's going to start to taper off when you start your RMDs. So the moral of the story is if you're not going to run into an estate tax, federal or state, if you can get to the Roth side, you're going to get more growth inside the Roth IRA. and all that growth will be tax-free. So one of the attributes we're looking for is somebody that doesn't need the money after age 72. So let's just say that a retired fireman and his wife, a retired police officer, they come to see you. And you say, what do you need to live on? They go, between our pensions and Social Security, we're covered. We've already been retired 5 years. We're good. We don't need to touch anything else. And then you say, well, I see you have $250,000 each in our IRA. That you start to work on converting that over to a Roth. Now, you'd hardly ever do that all in one fell swoop. Mm-hmm. You'd very methodically look at brackets, and that's what would drive your conversion. Now, there's some other traps we're going to talk about. We'll come back to some very important traps. One of the reasons to help you convert is when you have outside money. So back to this retired fireman and police officer. If that was the case, you would say, I notice you have $250 in your IRA, but you also have $75,000 of cash. Mm-hmm. And if we can use that cash to pay the taxes, that makes the Roth conversion even better. And we can demonstrate that mathematically. Now, taxpayers who can pay the conversion tax from non-IRA funds, again, that is a big thing. If somebody's going to have a state estate tax, like in Massachusetts, $1 million cutoff, I want to get them onto the Roth side, because if we converted 500,000 of the Roth, we're going to lose 150,000 to taxes, which is great because it reduces your exposure to state taxes. When you fill out the mass estate tax return, Bob, a Roth IRA worth $1 million bears the same tax as a regular IRA worth $1 million. But the Roth is worth much more. There's no one on this podcast who wouldn't take $1 million Roth over $1 million regular IRA.
Right.
So those are reasons to convert. Now, basically, what about somebody age 60, though, going down the path of small conversions until they die at, let's say, 85, instead of having their family have to take the money out over a 10-year period of time? That is important. And we have to remember post-death distributions to beneficiaries are tax-free. Now, one thing that's going to come up for many of our listeners in New York or California or even Minnesota, very high state tax states. So you represent a couple, they're living in Florida, but they started their life in New York City, and their children are all in New York City. So Bob, what is the state income tax rate in Florida? It's 0. But the state tax rate in New York City is give or take somewhere between 11 and 12%, is my understanding from my CPA friends in New York. So Grandma and Grandpa are down in the villages in Florida, and they start doing Roth conversions. Later, when those Roth dollars come back to the children in New York City, they're not writing out a check to the state of New York or to the city of New York, because it's a Roth distribution that's coming back to them. Right. So they create an arbitrage equal to about 11%, all things being equal, assuming the same federal rate, they create a state arbitrage. So when you look at a Roth conversion, you have to look at it through the eyes of first the married couple, and then through the eyes of the surviving spouse, because somebody will die first, right? Right. And there'll be a gap of time. And then look at it through the eyes of the children. And that becomes very important, because the children, if the children are in New York and the parents are in Florida, a Roth conversion becomes almost brainless because of that great state arbitrage. Mm-hmm. And it depends. Now, if the child's a neurosurgeon, he'll be in a 37% bracket, right? Yeah. But what if he's teaching kindergarten? He might not be in such a high bracket. Right. So you just have to look at all that. Now, when we look at this, there's a big picture of historically low tax rates. You could argue that under the Tax Cuts and Jobs Act, this 37% rate is low. And when the Democratic side of the aisle has power, complete unmitigated power, they will push that rate back up. We don't know what that will go to, but it certainly will go back up. Now, bracket-wise, always remember at least under the law today, the married brackets are twice as broad as the single brackets. So if a couple came to us, let's say he's a retired dentist, he has $2 million in his IRA, and they come to me and he has a serious health condition which will take his life in 3 to 5 years. I would want them to start doing Roth conversions now within the 4 corners of these married brackets, rather than sticking her with that big IRA and having to take out the RMDs.
Mm.
And what you do then is you would do a 15-year projection for RMDs, and you just assume he dies in year 3, 4, or 5, or model it so you can show each year. But you try to get as much converted as possible before he passes away, while you can still use those married rates. And that becomes a very important part of this process. We also have to remember the Tax Cuts and Jobs Act expires in 2026, and then that 39.6% rate will come back. So very important to look at. Now, when you're helping somebody with a Roth conversion, Bob, estimated taxes are critical. We have to make sure that the financial advisor is coordinating with the CPA that estimates are made properly. And that's kind of ministerial, but it has to be done.
Mm-hmm.
Now, here's the great question. If I lived in New York and I did $1 million conversion, I would owe quite a bit of New York taxes. That's a given, right?
Right.
But I want to pay those where I can get the best state income tax, the best federal income tax deduction for my state taxes as possible. Meaning, if I time that right and I owed $100,000 to the state of New York, the federal government might underwrite $37,000 of that if I can deduct those state taxes. Now, we might go back up to an $80,000 threshold on the SALT deduction. So trying to time my state income tax payments is going to be absolutely critical. Once Congress pulls back the curtain and decides where that cutoff is going to be, then, that's kind of where we are. We just need to know where we are there. Now, cash reserves. Here's a big thing. In today's very volatile market, I'm just going to pick on you for a second, Bob. If you did $1 million Roth conversion today,
Yep.
let's say you would owe between New York and federal, or New York and Mass, not federal and Mass,
Yep.
you'd owe 45% taxes, $450,000. I would want you to raise that $450,000 now and park it in a nice, safe place.
Mm-hmm.
Because what if the market fell from $1 million to 600,000, fell by 40%, and then you still had to take 450,000 out to pay taxes? That you would have it'd be a disaster.
Right.
Now, sometimes what we do on these big conversions, if somebody started, we would have them, for example, we're starting in January of 2023, and they were converting $1.2 million, I might have them convert $100,000 a month for 12 months. Mm-hmm. You know how you'd do dollar cost averaging when you were going into a 401k plan?
Yep.
You do the same thing in reverse, because that way, if you have an adverse swing in the market, what you wouldn't want to do is do that $1.2 million conversion in January, have to pay taxes on $1.2 million, and then have it only be worth $1 million by December.
Yeah.
And really, the world is very newsflash. I mean, the world's pretty dynamic right now. I mean, there's the Ronald Rumsted known unknown,
Right.
where the thing that nobody saw coming, right? And we need to be aware that the market could swing violently one way or the other. And now the other thing is, when you're talking to your clients about this, write this down. Use the phrase micro conversions. I want you to do a micro conversion of $28,000. Mm-hmm. When you use that word micro conversion, it's a very non-threatening, smoothing word. And I'm not saying we're trying to manipulate the clients. We're trying to put them at ease.
Yeah.
But, and then you say it's a very small conversion. We're just trying to thread brackets.
Right.
And that's really where this is. And to properly do that, you need to run a 10 or 15 year projection. That's going to be the really important thing, so you know where people are. So we talked about a lot. We talked about basis. Now, do not lose track of, if somebody has basis, we really want to evaluate whether they can do a conversion and use that basis to move the basis from a regular IRA into a Roth. And the higher the basis ratio, we're better on. Now, there are some ugly aspects to Roth conversions that will get financial advisors, CPAs, and lawyers in trouble. Taxation of Social Security benefits. If I do a conversion, will it impact the taxation of my Social Security benefits? Now, for most people, they have enough income that that's not a problem. They're already paying tax on their Social Security benefits. But for some people, we have to run the numbers and just, because I can't, if I convert $10,000 for someone, Bob, but their taxable income goes up by $18,500,
Yeah.
they're not going to be happy. The Roth conversion will have made no sense. Now, you brought this up when we were in the green room. I think you called it IRMA, but that Medicaid Part B premium. So I think what happens there is the more money I make, the more insurance premium I pay to basically out of my Social Security benefits. And if we don't tell our clients about that, they will become very upset with us if they don't see that coming. Now, there's another thing out there for younger people, and the gentleman that taught me this is a guy named Marty James from Fort Wayne, Indiana, but ACA insurance premium credit.
Yep.
The more you make, the lower your ACA premium credit. So if you knew you were going to retire at 56 and you're at 50 now, there's a big argument to try to get into some money over to the Roth between 50 and 55, so that later between 56 and age 65, when you can get on Medicare, you're able to rely on those Roth dollars, which won't increase your income, Bob, and that won't mess up your ACA credit. And this is really heavy stuff, but it's out there, and I think financial advisors can add a ton of value if they spend a minute and work through this. All these things by themselves are easy. It's when they all come together that we can get ourselves in trouble. And you're right, this does lend itself to a wonderful checklist of what people should think about. So generally, when you're evaluating a conversion, if you can keep somebody in the same tax rate that they're going to be in anyway, that becomes extremely powerful. And remember, you have to look at through three lenses: the married couple, the surviving spouse, and then through the children. Those are the lenses you're going to look at. Now, if I come to see you and I say, I want to leave all my money to Children's Hospital of Boston, you would never tell me to do a Roth conversion.
Right.
We would just do the beneficiary form and have my IRA go to Children's Hospital. On the other hand, if I come to see you and say, I want to leave all my money to my children and grandchildren, then we'd be working through the Roth conversion equation, especially in states, primarily in the Northeast, where you're going to get hit with a state estate tax. Because the math of the whole math of getting into the world of Roths is better when you're dealing with a state estate tax. A state estate tax gives you a real bonus on the Roth conversion. So what we're really looking at is people that have something going on in their tax return, like some type of charitable or NOL type carry forward that's going to give them a break, somebody with high basis. Am I in a lower bracket now than I will be in the future? Sometimes people have very large IRAs and they're sitting in a low bracket today, but they're going to be in a very high bracket later. I had a chemical engineer come to see me, and he had a big job with one of the paper companies, had graduated #1 in his engineering class twice. I mean, really smart. And he proudly told me that he was 69 years old, he had retired at 55, and he had kept himself in a 15% bracket for the entire time.
Wow.
And he had $5.5 million in his IRA. And of course, I knew this, but I was too polite to say anything. It was really, to be blunt, he was an idiot.
Yeah.
Because once we started the RMDs, he was going to go up into a 30-something% bracket.
Yeah.
He should have been filling up his lower brackets all along the way with Roth conversions.
Mm.
And he had missed this. So this is why you project things out 15, 20 years sometimes, especially for when income is predictable. Now, your income, my income, they're hardly predictable because we don't know what projects are going to come our way.
Right.
But if I was retired and had control of my income, I could pretty much predict that, within 5 or 10%.
Mm-hmm.
Now, remember, if somebody has outside funds, that makes a Roth conversion work. If I will not need the IRA for my living expenses, that makes it work. My time horizon. A gentleman age 60 doing a conversion is much smarter than his 92-year-old father.
Yeah.
Because he has hopefully 32 years to let that Roth run crazy.
Yeah.
But his dad only has, let's call it 5 to 15 years. Now, what about tax-free postmortem distributions? Don't lose track of that. And always think about the estate tax considerations. So those are all the things that really do drive a Roth conversion. So what we're trying to do, the success to conversions is not to jump too many brackets.
Mm-hmm.
For example, if I'm in the 12% bracket and a Roth conversion jumps me up to 32, that is not going to work. There's no way that math will ever work. Small jumps are okay. It's the big jumps that will kill you. And we kind of map this out.
Yeah.
Now, the other thing the financial advisors need to know, when money comes out of a Roth, it can be a qualified distribution, not subject to income tax, or a non-qualified distribution, subject to income tax. So a Roth can actually be subject to income tax if you are under 59 and a half and haven't held the money for a period of 5 years.
Right.
So what you want to do, here's the place that I worry about. It's somebody that wants to retire early, but all their money is trapped in a Roth IRA. They've been doing Roth conversions since, say, age 45, hoping to retire early, thinking that was a great plan. And then they come to see you and they have $2 million in a Roth IRA and no pension and no other money. And if in that situation, they may have to face into the fact that they can't get that money out without income tax or without a 10% penalty. Now you can recover your basis, but it becomes tricky. So you'd want to make sure you had a really good plan on that. Mm. So we have covered a lot of ground, Bob. I'm sure you have a few questions that might help our audience.
If you don't mind, because I know our audience will be deeply interested in this. I know you have spoken about hedging Roth conversions with life insurance. I'm curious about that.
This is a really big thing. First of all, there's a concept called IRA relocation, where I take my money out of my IRA during my lifetime and I jettison that into a life insurance trust. That works extremely well in states where you have a state-to-state tax and where you can use annual exclusions to make all those transfers. So that's kind of a big thing. So we like to look at that. And it's tricky to make IRA relocation work because what we're up against is we have to beat the ROI on the Roth. But the Roth is kind of handicapped if it's going to be subject to a state-to-state tax. Mm-hmm. So, for example, in your state, the state tax rate would be 16%. Where if it's in a life insurance trust, the state-to-state tax is 0, provided that trust was drafted correctly. It's outside of your estate. Mm-hmm. So a lot of what we like to do is use that IRA relocation. Now, beyond that, here's the harder concept. Money has to come out of a Roth over 10 years. So if I die early, or a regular IRA over 10 years, if my plan was to convert from age 60 to 85, but I die at age 70, that's a disaster because my family, I haven't had enough time to get everything into the Roth.
Right.
And we use a little bit of life insurance if I die early to basically allow my surviving spouse to wrap up that Roth conversion in the year that I die, while she can still use our married brackets. And so that's something that's just a very important thing that works for some clients. And again, I don't sell life insurance. I mean, so it's,
Right.
This is all just the math.
So it's interesting because now in the course of our conversation, we've mentioned numerous elements of a financial team, an estate planner, a CPA, a financial advisor, and now perhaps insurance agent along the way to make all this work. And it seems like a couple of questions. Obviously, some folks can have access to a Roth 401k at work, and in some cases, they might have the ability to do in-plan conversions. Any thoughts about that?
If you can do in-plan conversions, that makes a tremendous amount of sense if you're in the right brackets. But there's a trick here. So Bob, let's say that you have a client, we'll call her Tiffany. She is age 55. She's been in a Roth 401k at work for 17 years, long time. And now she's retiring, and she's going to move all her Roth 401k money into a Roth IRA. That seems like an innocent transaction, right?
Right.
When she moves from the 401k to the IRA, she loses her holding period. We spoke about this a minute ago. Remember, to get money tax-free out of Roth, you have that 5-year holding period. So she's at 17 years today because it's in a Roth 401k. Tomorrow, she moves it into a Roth IRA. She goes back to 0 years. She has to start counting again. The holding period does not tack, T-A-C-K, does not tack from the 401k to the IRA. You have a reset button. You have to press a start over button. What we do for almost every client is when they come to see us, if they do not have any money in a Roth IRA, even if the timing of a conversion is terrible, we have them convert $100 or $1,000 from a regular IRA to the Roth.
Right.
A small amount, because we want to start that 5-year rule. Because you only have to meet the 5-year rule on the IRA side once. But we want to start that so that we're going down that path.
Yeah. So last question, and then I'll invite you to come back on and we can talk more about other things, all things Roth and whatnot, tax planning for 2022. Obviously, Build Back Better is not the law of the land yet. It was going to eliminate not just the backdoor Roth, but the mega backdoor Roth. Is there still an opportunity for however few people can avail themselves of that to do the mega backdoor as well?
Absolutely. There is no doubt that people should, right now they can do that. I'm a little worried. I wouldn't let somebody do that without the sharing with them that Congress could retroactively backdate all this to January 1st. And then we'd be in a really terrible spot. But as we march on in time, that would be very cruel for Congress. If they're going to do it on April 18th, the day the president signs the bill.
Right.
Don't do it retroactively, because there'll be many innocent people, small fry, if you will, they will get hurt on this. I mean, it's one thing if, somebody worth $1 zillion does this and they're surrounded by wonderful CPAs who have given them great advice. But it's another thing if it's just the retired policemen and firemen that, mess this up. That's not fair.
Right. Well, so we've covered a lot of ground. Anything that we missed or anything that just bears repeating before we wrap up? It's been a pleasure as always.
Oh, no. I'm thrilled to be here. It's my honor, Bob. I just think open your mind to how powerful the Roth IRA is. And, you can certainly let Bob Powell know if there's things that you'd like to hear on these podcasts that would be more focused. We're glad to do that, because Bob, what I've been working on the last really 24 months is kind of demand pull education rather than supply push.
Right.
Letting the financial advisors say, this is what we need to know. We don't care about most of the stuff you're teaching. We care about this stuff, and let us know that, and we'll focus in on that.
All right. Well, I'll make this our invitation to folks who are listening to write to me, to write to you, and we'll hopefully satisfy their desire for the education that they want.
But no, thank you very much, Bob.
Thank you. It's been my pleasure, and we'll talk soon, I'm sure. Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.